Good morning. My name is Mark Wallace and I am Walter Wright's tax partner. Can I welcome you this morning to the webinar on the autumn 2025 budget. I'd be grateful if perhaps somebody could just put something in the question box to confirm that they can hear and they can see me. Thank you. During the course of this morning, if you have any questions, please put them in the chat box and I will try and pick them up as we go along. Well, what can we say about the budget this year? Well, if we go back to the previous budget in 2024, Rachel Reeves told us that she was raising taxes by about £40 million. Her comments at the time was that the country was in a difficult place, and that she said that any chancellor would do the same thing as what she was doing, and she would be a responsible chancellor that take a responsible action. Now, I don't want to be political about this morning, but what I will say is that we've had almost a repeat of it again. This time she's trying to fill a £21.7 billion black hole. So what does that mean? Well, it means that somebody somewhere is going to be paying some extra taxes. And who is it? Well, I think this picture here proves the people who are going to be paying the extra taxes are every one of us who's on this webinar this morning. It doesn't matter what our situation is, whether we're a retired pensioner or whether we're in business, taxes in some ways are going to be increased. So let's see what measures that she has put in place. This graph here is taken from the budget papers and budget document, and I meant to say at the start that we will be sending around copies of these handouts after the seminar, so you can see the detail on them. But what this shows is the various measures that have been put in place and the way that they're going to be raising taxes. If you look to the far right hand side, there is the largest section of the bar graph is the money that is coming from fiscal creep. I'll talk about that in a minute, but basically that's where the personal allowance has been frozen. And so the majority of the increases that we will feel, first of all, aren't coming in immediately. For one thing that's interesting about what's happened in this budget is a lot of the measures are being phased in over 2 or 3 years. And so what we'll see that as we get closer to the end of the 2020s, towards 2020, 30 and 2020, 30, 31, that's when the budget the budget increases will hit us the hardest. Some would say, commenting on it politically, that because of the electoral cycle, that we may well have a different government at that point in time. That's just a comment that has been made in the press, and I'm not going to speculate any further. Talking of the raises, I will just mention in passing the mansion tax, or what is called in the papers as the high value council tax surcharge. In a sense, it's a bit misnamed, because although it will be collected through people's council tax, the money will go straight to central government, whereas council tax money goes to the local authorities. It will only apply to homes that are worth more than £2 million, and the date that we will be looking is now. Whereas council tax is still being based upon some historical values, the government have tasked the valuation agency to go out and to find homes that are worth more than £2 million and to put them onto a register. So from April 2028, they will have to pay an extra charge onto as well as their council tax. The extra charge will start at £2,500 and will increase to as much as £7,500 if the home is worth £5 million or more. Actually, when you look at the overall scheme of things, it raises a very little amount of money, and I think this has been introduced more from a political standpoint rather than actually to raise funds. It's interesting that there is no sort of fixed up-to-date register of current values, and the valuation office no doubt will have a lot of work to do over the next 2 years to identify these properties. The gambling tax was speculated about before the budget, and there was a lot of lobbying from pubs and other places that had gaming machines, because there was speculation that if the duties went up on gambling, that would make the machines and the pubs more expensive, and that would mean that people wouldn't come into the pubs in order to spend their money. And so what we've got is almost a halfway house. In very short terms, if the gambling is taking place online, then the duties are increasing from 21% to 40%. But there's an exception for horse racing gambling, because they pay a separate duty which goes straight back into horse racing. But one thing that was made clear is that any betting that takes place on premises or betting terminals will keep the 15% rate. This is very much the way of trying to claw back money from a lot of the major betting websites. If you look at most of the betting websites these days, they're based away from the UK for tax reasons. And so basically what they're saying is, yes, you can have a betting website based offshore, but you're going to have to pay a significant amount of taxes to us on the bets in order to operate in this country. As a side issue, Rachel Reeves mentioned and made a point of it that bingo halls will no longer have to pay the bingo duty. This is a very old duty that was introduced back in the 1970s, and that has now been abolished. Alcohol duties are going up by the retail price index, and landfill taxes are going up as well. Road funds will go up by RPI as well, and vaping duty is going to be paid by wholesalers from the 1st of October 2026. So as I say, there's a lot of sort of bits and pieces in the background that will be affecting us. Somebody's put a question in the chat about, will farmhouses be affected by the mansion tax? The honest answer is we haven't seen the full details, so I can't answer that question. My speculation will be that if it is a residential property and paying council tax now, then yes, it will potentially be caught by the new rules. It's going to be based upon properties that are paying council tax, and one of the things that the valuation office has been told to do is to go through council tax and look at the top 2 tiers. Obviously the tiers the wrong way around, but the top 2 tiers, the most expensive properties on the register, and use that as a guide as to which properties to focus into. So honest answer, I don't know, but my speculation would be if it's paying council tax, then yes, it will be caught by this regime. Okay. Right, I've got no more questions, so I'll move on to the next slides. So, turning to business and corporate tax. Well, to start off with, there was confirmation that corporation tax will not change for the life of this Parliament. The corporation tax has been fixed for a number of years at 25% for the higher companies. That's any company with profits more than 250,000, and then underneath, and the lower ones 50,000 profits 19%, and then in between that you have what I call a hybrid rate of 26.5%. Those rates are staying exactly the same. What was also announced was that the 100% first-year allowance for purchasing new vehicles in a business will remain. it's interesting that when this relief was brought in, originally it was going to expire, I think it was in 2024, then it was extended 25 and 26, and now it's been extended into 2027. I would perhaps mention that I think there will be a time when the first year allowance for new electric cars will be removed. I think it will depend upon how long it takes for the government to meet their targets. And also first year allowances for electric vehicle charging points. If you put an electric vehicle charging point in at your workplace, then you will be able to claim full tax relief for that charging point when it is put in against the tax bill. So that's some good news that remains. But talking of capital allowances, there was some announcement about a new writing down allowance change. So at the moment, if you have an item that goes into the main pool, capital allowances pool, so this is where we buy equipment, and you can't claim the allowances in full in the first year, then you get a writing down allowance for that equipment over a period of time. And it's on an 18% basis. So if, for example, you buy a motor car that is that qualifies for the main rate pool, and motor cars have to be, that would have to be a car that's not, say for example, let's say a second-hand electric vehicle, then you get 18% relief in the first year, and then it would carry on in future years. That rate is going down to 14% from the 1st of April 2026. But for most of our clients, most equipment that they buy qualifies for the annual allowance. So what this means is that if you buy a piece of equipment, most of the time you get immediate tax relief at 100%. So you buy, for example, a digger and or a tractor, you spend £100,000 on it, and that's £100,000 taken off your tax bill in the first year. So the annual allowance is staying with us, but there are limits to that, and that is that you cannot claim more than £1 million worth of relief at 100% in one tax year. For the majority of our clients, that's not a problem, because most businesses are not spending that amount of money on equipment and capital expenditure in a year. However, there are certain businesses that don't don't do that and have a problem. And in fact, the leasing industry, and particularly the plant hire industry, have been lobbying the government for some time. Because if you think about it, if you are a plant hire company, it doesn't take too much for you to spend well over £1 million a year on your equipment. A lot of the equipment has to be replaced regularly. It has to be brought back into use because it may be that it's broken down, and so they have to replace it. But they're spending a lot more than £1 million. And so they felt that they were a bit of a disadvantage. And at one point, the government said, well, the answer was, we'll bring in what's called full expensing for companies. Now, what that means is if you went over the £1 million, you could still claim full relief. But there were limits to that. And one of the things that they said was that you can't claim full expensing if you're a leasing company. So what has been announced is there's a new 40% allowance that applies from the 1st of January 2026. So if you have exceeded your £1 million and you can't use full expensing, then you can claim this 40% allowance in the first year. But it's still limited. It's limited. It can't be claimed on cars. It can't be claimed on second-hand assets, but it can be claimed, and they've been claimed on leased assets. So in a sense, I think the message is that for most of our clients, this doesn't really affect them, because they will be claiming full relief using the annual allowance. It's only a handful of clients and a handful of businesses that this affects. But the reason I wanted to cover it is because there has been a great deal of coverage in some of the press coverage on this one. Also, in the small print announced after the budget was that the corporation tax penalties for filing a corporation tax return late are going to be doubled. Doesn't actually say the date from which it's coming in, but what it is saying is that if you are late with your corporation tax return, the penalty for getting it late is going to be doubled. So currently, if the return is late by 1 day, the penalty is £100, and that's going up to £200. And the penalty regime gets worse than the number of times that you actually fail. And in the worst case scenario, the maximum penalty is if you're late 3 times in a row and your returns are 3 months late. The penalty at the moment is £1,000, and that's going up to £2,000. Also, one thing that was in the budget papers is confirmation that the UK is signing up to what is called grandly the Crypto Asset Reporting Framework. Now, what this is a way of the tax authorities around the world of trying to get hold of people involved in cryptocurrency. Cryptocurrency has been seen by some people to be going underneath the radar. It's not like regular UK bank accounts where you've got physical statements being sent out, and it's difficult for the authorities to actually know what's going on. So what's a lot of the countries are introducing, and as I say, the UK is signing up to it, is that if you are what's called a crypto asset service provider, so that's the people that if I was going to be involved in cryptocurrency, I would be putting my money with. If they are in the UK, then they have to collect information about me. They have to do due diligence, checking my passport, driving license, checking that I'm a valid person, and also to make a report on an annual basis to the tax authorities. Now I say, hang on a minute, if it's UK reporting people, what about people overseas? Well, the idea is that because all of the tax authorities are signing up to this regime, that over time, it doesn't matter what country you're working with, they will be reporting. And what will happen is there'll be a central system which will spread the information around the various authorities. Sometimes you have clients send a form called the factor form, where the bank asks them to confirm their factor status. And that is part of the reporting regime that takes place on company bank accounts, and particularly exchanging information with the US authorities. Well, this, when it's introduced, will exchange information between countries. Historically, HMRC have been on the back foot with cryptocurrency because it's changing constantly. But the new rules, as I say, on the reporting will come in place from 1st of January 26, and the first information exchange will take place the following year. And on tax returns at the moment, there's actually a box that you have to complete to say whether you've actually had cryptocurrency transactions. So HMRC will be looking at this, and it's an area which they see that they'll be able to get money from in the future. Recruitment agencies will be responsible for collecting pay-as-you-earn and national insurance if they are using an umbrella company structure. So for those that are not familiar, an umbrella company is a company which employs a number of individuals, and then that labour goes out, gets provided to another party. So for example, I could have 10 people working for me. I would be taking pay-as-you-earn, etc. off them, but I would be supplying their labour onto somebody else. The problem with this is that some of these umbrella companies are here today and gone tomorrow. So what some umbrella companies do is set themselves up, trade for 6 months or 12 months, and then they roll themselves up and they end up going bust or not paying their tax dues. And it's an area which HMRC are constantly trying to deal with. So what they're going to do and change the rules is from the 6th of April 26, if a recruitment agency is using an umbrella company to provide labour anywhere in the chain, the recruitment company will be responsible for operating the pay-as-you-earn and national insurance. So if you are involved in buying in labour and you buy in temporary labour and you're using a recruitment agency, you don't have a problem because the recruitment agency is the one who's got to sort this out. If, however, you're contracting directly with an umbrella company or somebody else in the chain contacting with an umbrella company, then the end user will be the one who will have to sort this out. So, for example, if we were having temporary staff brought in, we will now have to ask questions about, well, how are they paid? You know, is there an umbrella company in the structure? Because if it is, then this will be our problem. Further guidance will be issued closer to the 1st of April, we're told, as to how this will operate. But I think the important thing is that people look at where their labour force is coming from, and if they have any doubts about it at all, they start making investigations now. Also hidden away in the text was a change in emphasis on HMRC on share-for-share exchanges or demergers. So at the moment, if you have a group of companies and you want to split them up, so perhaps you've got two shareholders, they've been together for the last 20-30 years, and they want to go their separate ways, you can do a demerger. And if you do a demerger in the correct way, it can mitigate tax charges. There was recently a case that went through the courts because there was a demerger that took place, and as a part of this there was a lot of changes in the way that the structure was made that also saved tax in the long run. And HMRC took the people to court and said, well, we can see why you're doing the demerger, but you're doing it purely for a tax reason. Now the courts turned around and said, well, actually the legislation as it was said, if you had a commercial reason, and that was the overriding issue, it didn't matter that the tax savings came along, that was just part of the overall package, and therefore HMRC lost. So what the government are doing is changing the rules, and so from budget day, if a demerger of a company takes place and they can prove that as a part, additional arrangements are played, so you put additional steps into the process to obtain a tax advantage, what this means now is that HMRC will be correct to deny you the tax clearance. Now what that actually means is that if you take place for that demerger at that point in time, it could well be that you have a lot of tax to pay when the demerger takes place. Very often when demergers take place, what you're doing is you're swapping shares for shares and there's no cash, so therefore you can't pay any tax, and that's the whole point, that you hold the tax liability off until a later date. Now there has been a bit of a transitional thing. If you've got clearance from HMRC for a transaction, you've got 60 days from budget day to complete that clearance and that transaction. If that transaction takes place, say 90 days after budget day, HMRC says that you will either have to reapply for clearance underneath the new rules, alternatively you will have to you'll have to run the risk of HMRC coming back to you and saying you've done it for tax avoidance reasons, and therefore you've got to you've got to stand the risk of having to pay taxes on which you wouldn't have expected. And also, and this was in the budget papers, but no mention at all in the budget speech, it's been confirmed that the UK will be moving towards mandatory e-invoicing for VAT invoices from 2029. So for VAT at the moment, if you're VAT registered, the majority of people are in what's called making tax digital via VAT. It means they have to keep their records on VAT, so the actual transactions, but there's no requirement for invoices to be held electronically. You can still issue paper invoices and so on. And what a lot of countries have done, and in fact we're probably about 10 or 15 years behind everybody else, is introduce a system where invoices for VAT registered people are also issued electronically. Now, just to be clear, they're not saying that you can't issue paper invoices, They're not saying that you can't retain paper invoices, but what they're saying is that when you issue an invoice underneath this system, your system will have to be capable of transmitting details of that invoice to a central location. There was a consultation paper issued on budget day where there was a complete, which asked a list of questions. One of the questions is, should that central person be HMRC, or should that be your software provider, or should it be somebody else? So it's clear that although they're talking about it and talking about it coming in from 2029, there's a lot of details to be thrashed out. But the whole principle will be that if you're VAT registered, you will have to get used to the idea of having to send your invoices using your software. Now, I think what a lot of people think is if you're sending invoices using your software, you'll probably just send a PDF of that invoice to your customer as well, or something like that. How it will work in practice, we're not too sure. But what we would, I just earmark it that it is coming onto the radar. And it also means that perhaps if you have got a hybrid system where currently you might use a spreadsheet or something to keep your VAT records, that when this comes in, you're going to have to look at changing to software that's capable of issuing electronic invoices. So
electronic invoices, or e-invoices,
I do apologise.
are structured.
So I do apologise for that. So just to be that on your radar. Moving away from business taxes, we move on to employment taxes. And when we look at employment taxes, that basically there's been a little bit of changes here and there. So first off was the change in the home working allowance. Now, if we go back to COVID times, most people were working from home, and HMRC and the government said, yes, if you're working from home, you can claim £312 a year as a home working allowance. There was a choice. Your employer could pay you the £312, and that would be tax-free. Or if your employer didn't pay you, you could claim it as a tax relief on your tax return. And most employers weren't going to pay this £312 tax-free. So most employees claimed that tax relief on their tax return. Probably about 2 years ago, there was a change in the guidance, and it was that you could only claim that allowance in future years if you were required by your employer to work from home. So what that meant was that if it was your choice, you couldn't claim it. It was only if you were required, or you couldn't work at your employer's premises. So for example, it was 200, 300 miles away, or they had no premises at all. So what what was brought in from April next year is that you can't claim that £312 allowance if in any circumstances whatsoever. What you can still do is your employer can pay you the £312 allowance. So I don't know if that's clear. So you can't claim it on your tax return, but your employer could pay it to you. I would imagine that this will probably see the end of it, but it's the case. Now somebody has raised their hand. If you've got a question, if you can just put it in the chat box, in the question box that's on the screen, then I can actually see what the question is. Is that okay? Right. So the £312 claim on your tax return is going from the next tax year. Employee car ownership schemes, there are going to be changes in the employer ownership scheme. So what HMRC have been concerned about for a number of years is where you may have a company that can go to a leasing company and lease a car cheaper than what I can personally. So it might be the case that because the company is leasing a lot of vehicles, that as an employee, the company can say, well, I tell you what, we'll sign the agreement with the leasing company, but it will be your car. Can you pay us? You can pay us back the amount of the lease. So that's fine. However, what was worked out a long time ago by HMRC was that, well, if you're in that situation But the benefit in kind, if the employer had provided you the car, was more than the lease payments, there was a tax saving to be had. And so they've been fighting these schemes. So what has now happened is they're now bringing rules to catch these schemes and saying, in future, if you get a car via your employer, it doesn't matter whether you reimburse the full cost, you will pay a benefit in kind in future based upon the vehicle that you're being provided with. And if you do pay anything towards that car, then there may be circumstances, and I won't go into that now, where that can reduce that benefit in kind charge. Now, there was particularly in the motor industry, a lot of fight back when they originally started talking about it. So what was announced in the budget? Well, these changes will come in force in April 2032, which is a long way ahead for existing vehicles. But if you sign a new lease in future, these new rules will come into play. So so I think what I'd say is take advice if you are going to sit that situation. And also, I'd just like to remind people that last year HMRC changed their guidance on double cab pickups. So essentially, if you buy a double cab pickup after April 25, it will be classified as a car rather than as a van. There is a transition where existing ones will remain classified as a van up to April 29, but it doesn't matter when you bought the van, the double cab pickup from April 29. So come 2030, all double cab pickups will be classified as cars rather than vans, which will increase significantly the amount of tax that people are paying on these vehicles. It was announced that employers can now reimburse employees for eye tests, flu vaccines and home working equipment from April 2026. Now, just to sort of explain, I think this is more of a tidying up more than anything else. Currently, if as an employer we want to offer flu vaccine, employees to have flu vaccines, if we book the appointment, if we pay for the appointment, if the chemist or the company we're using invoices us as a firm directly, it's tax-free. But as an administration issue, if the employee chooses to go to their own chemist or doctors to be vaccinated and provides us a receipt, underneath the existing rules, that is not tax-free, and they should pay income tax on that. So that's the current situation. So what they're doing is they're bringing it in and saying, okay, let's be pragmatic here. If you've got an employee who comes to you and says, I've had my eyes tested and here's the receipt, rather than you having to apply pay as you earn to those payments, that will be tax-free as well. The EMI scheme, so from some people and some companies have employees of whom they've given options underneath the EMI scheme. And it's been a bit of an issue because the limits have stayed the same for many years, and there's been a significant increase in those limits. So what the new limits are is that you can now issue share options up to a value of £6 million. That's across the company. The value, the gross assets of the company are now 120 million as opposed to 30 million. And EMI schemes can be offered to companies that employ more than 500 employees as opposed to 250 ones. It's just really, I think, recognising that the rates haven't changed for some time. And the one that caught the headlines, salary sacrifice for pensions. There was a lot of lead up to the budget about whether national insurance will be levied on pension contributions paid by companies for their employees. There's a number of cases, particularly in the city, where people will choose to have their bonuses paid in the form of a pension contribution. Or people might say, well, actually, rather than having a salary, I have it paid into my pension. The benefit is that the company saves employers' national insurance and the employee saves employees' national insurance. From an income tax standpoint, it works out to be exactly the same, because if you pay into a pension scheme, you get a tax relief on it if you pay into it personally. So what was announced was, first of all, to be clear, this is from April 2029. So if you've got arrangements in place, or you've been planning to do it in the next year or so, then that will still remain the case. You can still do it. These changes will only come in for pension contributions paid after the 6th of April 2029. So somebody's just asked the question, do employers have to reimburse employees for eye tests? I think underneath health and safety legislation, I think it's more an HR issue rather than a tax issue, but as I understand it, if you have employees who are using VDUs, then you are underneath a legal obligation to provide eye tests. But I say that's an HR issue rather than a tax issue. But that's why the legislation was already introduced, was saying, well, because you have to or should allow your employees to have an eye test every year, that will be tax free. What I will say on that note is to be clear, is that when it comes to spectacles, you can only reimburse the cost of spectacles if they are specific VDU spectacles. And most opticians will tell you that these days most glasses are multi-purpose, and therefore most glasses cannot be reimbursed tax-free. It's only the eye test that can be tax-free. So I hope that answers the question. If not, let me know. So yes, just going back to the salary sacrifice, it comes in from April 2029. So if you've got arrangements in place, then you carry on. It also means that you ought to consider making contributions into the pension scheme before then, and it may be that you need to bring forward the amounts that you pay into the pension scheme. There are limits, of course, annual allowance limits, and if you exceed the annual allowance, £60,000 for most people drops down to £10,000 for high earners. Then you have to pay an income tax charge. So you need to take advice if you're going to pay large amounts into a pension scheme. But what has been announced is from April 29, the first £2,000 will be exempt from national insurance, and then after that, national insurance will be levied. But there's very little detail as to what's meant by this. There was a budget paper released. Reading it didn't give any indication at all. But what it did say was this will be aimed at salary sacrifice schemes. And it goes on to say salary sacrifice is when you agree to reduce your gross salary or sacrifice a bonus, and in return, your employer pays the same amount into your pension. So if you are, so my reading of that is, if you're an employer and somebody's on a salary of, let's say, £50,000 a year, and you say to the employee, we're going to start paying £5,000 into your pension scheme, that's not salary sacrifice, because you're paying it in addition to the salary, and therefore it won't be caught. If you are your own running your own business, a question I've got is, well, if you normally take the minimum salary from the company, which most people do, and then choose to pay the rest into a pension scheme, is that salary sacrifice or not? It's very hazy in terms of what's made. My understanding, reading the papers, is they are aiming at this, and what they've got on their sites is basically people in the city who are saying, well, actually, I've got a bonus of, let's say, £50,000, pay into my pension scheme, and it escapes national insurance and it escapes income tax. So we'll have to wait and see what the detail is coming out of that, but it may not be as far-ranging as what we thought it was originally. As I say, what does it mean about the employer deciding to make arrangement and employees? We've got 3 years to look into this. The benefit in kind rates, they'd announced these rates about 4 or 5 years ago. So if you've got a company car, so would carry forward stop and drop to 2,000. Somebody's asked the question about, will the carry forward of the annual allowance stop and drop to £2,000? My understanding is no, they're going to keep the annual allowance at the limits at what they are at the moment, so £60,000 per year, and you can carry forward that relief up to 3 years, assuming that you haven't used it before. As I say, I'm always careful when I'm talking about that, because if you're a high earner, then in that situation you will end up perhaps losing some of it, because once you get to £240,000 worth of income, the amount you can pay into a pension scheme drops back. I hope that answers that question. Employment taxes, yes. So benefit in kind rates, the benefit in kind rates that you pay on a company car were set out a few years ago, and they're still staying in place. But just to sort of earmark that every year, the income tax that you pay on the benefit of having a company car is going up by 1 percentage point. And that also applies to electric vehicles. So if we go back probably about 3 years ago, if your company provided you with an electric vehicle and it was fully electric, there was no benefit in kind. I pay no income tax as an employee. And then last year, the 24-25 tax year, was the first, they started introducing a benefit in kind charge. And that is going up gradually. Sorry, I think it was the previous year, but that was going up gradually. So by 27-28, you will pay a benefit in kind charge based upon 5% of the list price of the vehicle when it was new. If you actually do the mathematics on it, it's still a very low income tax charge, but it is an income tax charge nonetheless. And the employer will have to pay a national insurance charge on that as well. The top rate, the maximum rate, is 37% of the list price, and that stays the same as before. Very few vehicles on the road are at that level. So I say benefit kind rates go up by 1% as planned. The benefit on full electric cars will be 5% as planned. And what one thing that was interesting is they brought in an easement. So hybrid vehicles, because of the way the rates work, the benefit in kind charge is based upon a combination of the CO2 emissions and also the number of miles that the car can drive on the electric mode. Now, if you've got a hybrid vehicle, even though it may run on EV, if it can only do 30 miles, then underneath the current rules, you'd be taxed on 18% of the list price. Well, what will happen in future is that there's going to be an easement that will say that if the vehicle was registered from the 1st of January 25 and complied with a emission standard, and it's and one of the new emission standards, that the benefit in kind rate will drop from 18% in the worst case scenario down to 1%. It's described as an easement, and the legislation says it's temporary, although how long that they mean by that I don't know. But I think what they're trying to do is recognise that actually hybrid vehicles were not very attractive to company car drivers because of the fact that the benefit in kind rate was so high, and they're saying that if you get a fairly new one, that we will allow you to have that vehicle and pay a very low benefit in kind charge rate. I would imagine when we see the detail that it will be the same as electric vehicles, that although it says 1%, it will then go up to 5%, and it would be nonsensical not to do so. While we're talking about EV vehicles, just something to highlight is that the government produces every quarter a table of the amount that it costs for fuel in vehicles. Now, if you're an employer, you can reimburse, and if you're an employer who's got, and you've got people with a company car, you may pay for the running costs, but you want to reimburse the employee for the cost of fuel. So you can use these tables. But what's interesting, the reason I highlight it is that we've been quite used to having the tables and the amount changing depending upon the vehicle, the engine size, the fuel. But for EVs, for a long time, there's been a composite rate. And earlier on this year, it was announced that in future, they would publish 2 rates for EV vehicles. So if you're reimbursing business use of an electric vehicle to employees, you will reimburse 7p per mile if it's on a home charger, and 14p a mile if it's been charged on a public charging system. So just to be aware that you now have to work at, when the employee puts in the claim, they have to say, and you have to be fairly sure that it's accurate, where they've charged the vehicle to determine whether they have the 7p rate or the 14p rate. Well, another reason for mentioning this is if we just jump back to the previous page, you'll see that a small petrol engine is 12p per mile. Whereas if you have an electric vehicle, it's 14p a mile. And the reason for this is because the stats tell you that electric vehicles charged at public charging places are more expensive than a petrol. And the road fund duty take is going down because electric vehicles pay lower road fund, and the fuel duty is going down as people move to EV. And as I think most people be clear, and know now, the government have announced that that electric vehicles will have to pay a surcharge, as I call it, on a pence per mile basis. They don't quite know how it's going to work yet. Although it's been announced, there's been a consultation paper. The suggestion in the consultation paper is that it won't be based upon a black box in the car. What EV drivers will have to do in the future is when they renew their road fund license, they will have to estimate how many miles they're going to do in that year. And then at the end of the year, they'll have to present their car to someone. The paper says it will probably be an MOT centre. And the MOT, and let's say it's an MOT centre, will then send a report to the government saying, oh, Mark said he was going to do 10,000 miles. Actually, he's done 12,000 miles. So can you send him a bill for an extra 2,000 miles? It's going to be interesting to see how in practice that's going to work. It seems as if there'll be a lot of administration involved in that. I think personally it would be far simpler to do it in arrears and just say you've done 10,000 miles this year and have the payment for the bill that way. But interestingly, the budget papers make it clear that they do actually expect the take-up of electric vehicles to drop as a result of the new pence per mile basis. Any questions on business tax before I move on to income tax? Right, okay, good. So income tax. So the income tax rate allowances are staying the same. Underneath the last Conservative government, they were fixed, and it was going to be the case. And when Rachel Reeves had her budget last year, she said, yes, I'll keep the Conservative fix, but then I will start increasing the allowances. So what she's announced is that they're going to be frozen for another 3 years until 2031. And I thought this graph was interesting because this graph shows the number of people who are paying high rate tax, and this is why this idea of fiscal drag yields so much money, because if your allowances stay the same, if your thresholds stay the same, but your income rises, which of course is what happens because of inflation, because of the cost of living, it means that more of your income is taxed at higher rates. If we go back to 1990, it was roughly about 6% of people were paying the 40% rate of tax. Now, based upon the first year, the stats we have at the moment, it appears that roughly about 19% of people are paying higher rate tax. And the projections are is that will increase further as we go over a period of time. The Times has produced a graph showing the data, and this graph here shows quite clearly how many people are going to be brought into income tax as a result of this. So if you go back to 23-24, it was roughly about 2.5 million extra people will be paying income tax, as far opposed to 2030, where they estimate it'll be 5 million. And there's almost the same number of people will be brought into paying higher rate tax. And so this is why freezing the allowances brings such a tax yield, and why it's actually quite easy, because it's easy for them to say they haven't increased tax rates, but they have to take increasing the tax take. But what they did also announce was that the other rates were going up. So property tax is going to be levied at an extra 2%. So if you've got rental income as an individual from April 2027, and we have to be clear about the dates these are coming in, because we'll see they're not all consistent. From the 6th of April 27, so the 27-28 tax year, you'll be paying an extra 2% on the income that you have. So there will be so you'll have basic rate tax 22%, high rate tax 42%, additional rate 47%. And they also confirm that the rental room allowance stays at £7,500. So this is where you may have a lodger in your house, and there's an allowance that you can have of £7,500 a year tax-free. Well, that last increased in April 2016, and that's staying the same as well. But that's going to hit a lot of landlords. I'm not too sure what will happen. If you read some of the speculation, some people say that people will give up renting properties. Other people say, well, what will happen is that rents charged to the tenants will go up as a result. But what will be clear is that there will be a hit in the tax bill of individuals. Also, savings rates. Saving rates are going up from the 6th of April 2027. So the same thing as the property, income tax on savings will go up. Basic rate 22%, high rate 42%, additional rate 47%. But the exemptions that we have at the moment will stay in place. So to be clear, if you're a basic rate taxpayer, you can have £1,000 worth of interest tax-free in a year. If you're a high rate taxpayer, you can have £500 worth of interest tax-free. And if you're unfortunate enough to be paying the 47% rate, none of it, all of your interest is taxed. You don't get an allowance. Those allowances are staying in place, as is the £5,000 starting rate for lower earners. Now, without wanting to go into a lot of detail this morning, basically, if you're somebody with an income of, let's say, £15,000–16,000, this starting rate effectively exempts the interest, so that they don't have to collect small amounts of interest, income tax on interest. ISAs, the ISA's allowance is staying the same. So just as at the moment, you can have an ISA every year and put up to £20,000 into your ISA. What is changing is that in future, you'll only be allowed to put £12,000 worth of your money into physical cash deposits, and you will have to, if you want to put the full 20 in, you'll have to put that excess into stocks and shares and unit trusts and those sort of investments. It's to encourage people to start investing in stocks and shares. Dividends taxes. Dividends, and this is where on dates we have to be clear. This is from April 26, so this is next year. My advice to company directors and owner managers is you may wish to think about taking larger dividends from your business in this financial year. You have to make sure you've got sufficient profits to take it, and it may be that if it pushes you into a different tax bracket, it's not wise. But it's worthwhile looking at that probably in about February time and saying, can I take an additional dividend to take it at the lower rates rather than the new rates that are coming in from April 26. Essentially, they're going up 10.75% for the basic rate, 37.75% for the for the higher rate taxpayers, and the additional rate. So that's people who are earning more than 120 odd thousand pounds a year. Their rate is staying exactly the same at 39.35%. So it's actually hitting those at the basic rate and paying the higher rate tax. For people who may borrow money from their company, there's a tax called Section 455 tax. You may have heard us talk about that. That increases to 37.75% as well. And here's a graph from the budget papers that shows you what's happening. So the top is the top shows the tax payable if you have income as employment income, then if you have it as a dividends, and then interestingly what they've done is they've done one in the third one that says this is the tax you pay if you take your dividends and you take corporation tax into account. And as you'll see there, the tax payable on dividends if you take corporation tax into account stays about the same as if you took it as salary. So what they're saying is, look, if you have money that goes into a company, you pay corporation tax and then you pay dividend tax on top, and therefore you're paying effectively the same as if you would do if you took it as a salary in the first place. I churned some figures just to see what it looks like, and so if you had a company that's earning profits of £50,000, the corporation tax is £9,500. Under the new regime, if you took that money out as a dividend, you'd pay £3,000 worth of income tax, and that leaves you with £37,498 in your pocket. If you decided to take it as a salary from the company, the tax and national insurance would be £8,836, leaving you with £35,923. So they're still saving money by having a dividend. It's just the savings are a lot lower, but the savings are £2,205. However, if you increase that further and say that I'm earning £100,000 a year, then you're left with £63,000, which means that the tax saving of taking it as a dividend is not 2,200, it's 1,600. And as you churn the figures through, the more you take from the company, the less savings you have from dividends. But one thing to note is that if you got rid of the company altogether and you were self-employed, you'd be left with 69,300. And I think what they're trying to do is trying to say to people, well, don't have a limited company just for tax reasons. You may be better off now to be self-employed rather as a limited company. The problem you have is if you are a limited company, there's tax charges on getting rid of it. So you may not necessarily want to move from a limited company to self-employed, but certainly if you're starting up again, depending on how much your profits are, you may be better off now being self-employed rather than having been employed. Where there still may be savings is if you earn £100,000 a year and you only take 50,000 from the company and leave the other 50,000 to take out the company at the end when the company's wound up. One thing I would just mention in passing is they have removed the dividend credit for non-residents. I mentioned this because for those that are old enough, there used to be tax credits on dividends, and they kept that in for people who are not resident in the UK because they're not paying tax in the UK. What it did mean was that you could almost take unlimited dividends from your company and not pay any tax if you were not resident in the UK. Okay, I've got a specific question about the property tax. I'll come back to you, Nicola, if that's all right. I'll talk about that outside the call. Okay, yeah. So basically, what they're saying is non-residents will be taxed as if you're resident in the UK. That means that if you were leaving the UK, you may well end up paying a lot more tax on your dividends if you are living, let's say, in Cyprus, and you've got a company in the UK and you're drawing it as dividends. And so they're removing that, and they're also bringing in a charge that says if you leave the UK and then come back in the UK within 5 years, that would be the case. On investment schemes, the limits for the size of the company are increasing for things like EIS and SEIS. But one thing to be aware of is that the venture capital trust scheme, and this is where you may give your money to a portfolio advisor who puts your money into a unit trust, that is reducing from 30% to 20%. So if you put money into a VCT, if I put £100,000 in, I could claim a £30,000 tax rebate on my tax return. That is going down to 20%. I'm not too sure why that. I'm not too sure what the rationale is for that, but that is going to be a tax reduction in the future. Moving towards the end, capital gains taxes. There's no change in the rates. Just to remind you that they did change in the last budget, and entrepreneurs relief, that is now called the business asset disposal relief, the BADA, that rate was 10%, 14% in the tax year that we're now in, and from April 26 it will be 18%. and there's another relief called investors relief, and that will also be going up in line. One thing as an anti-avoidance measure is if you are incorporating your company. In the past, there used to be two ways you could do it, and there still will be. One would be that the company buys the assets off you, and you pay tax when the assets are bought off you, and you might have a large director's loan account that you can take out that company tax free. Another way would be that you issue shares, and that parks any capital gains tax until you eventually wind the company up, and that's what's called incorporation relief. What at the moment is automatic; it doesn't have to be claimed. And what they're saying is from April 26, if you claim incorporation relief, you will have to send a physical claim into HMRC with your tax return. Employee ownership trust, they're changing the tax benefits of this. So an employee ownership trust is where you may have a limited company that's owned by 2 or 3 people, and they want to pass that on to their employees. It may be that they say, well, actually, we're not going to sell it to lots of people. We're not going to sell it to a third party. We're going to sell it effectively to our employees. It's called the John Lewis method, and very often when they talk about it, they talk about the John Lewis model, because that's how John Lewis is owned. Basically, the employees all own a share in the company. So to encourage people to do this, a few years ago, it was announced that if I was selling my company to an employee ownership trust, the employee ownership trust would pay me for my shares. That would be based upon the market value of the company. So it could be a significant sum. Because the money was coming from an employee ownership trust, and because of all the regulation and rules behind it, that money that I get would be tax-free in my hand. So there would be an incentive on me, and a significant one, to sell my company to an employee ownership trust. Well, from budget day, and it's because HMRC and the government feel that these arrangements have been abused, 50% of the gain will be taxed. And I will have to pay capital gains tax on 50% of the capital gain that arises. And they're saying you won't be able to claim entrepreneurs relief, business asset disposal relief. It will be taxed effectively at 24%. And they're saying that when the trust disposes of those shares at some point in the future, that capital gain will be taxed. So they're saying you can use an employee ownership trust. There is an incentive on me as the owner to sell to an employee. There's all that incentive, but in future they will be collecting the tax on these trusts. Inheritance tax rates stay the same, but what they did announce was that they're going to listen to a lot of the campaigning that's going on. Initially, so most inheritance tax reliefs can be transferred between husband and wife. So if my wife leaves me all of her assets when she dies, no inheritance tax is paid at that point, and I can claim the allowances that she could have claimed. But originally, when the restriction in the business property relief allowances were announced, and just to remind people, what that meant was that the first £1 million worth of business property assets or farming assets could pass free of inheritance tax, and the excess is taxed at 20%. What originally was saying was that if my assets went to my wife, she doesn't inherit my £1 million allowance, which therefore means that she would pay, if you said the business is worth £2 million, my million goes to her, she has her £1 million allowance, therefore £1 million worth of assets would be subject to OHT. Whereas if I had given my share, 50% share, to my children on my first death, I would claim my £1 million and she claim £1 million. So what they're saying is that can now be transferred and to get rid of that problem. So that's good. What I would say is you still need to think about planning, because the residential nil rent band, and so that's a relief that can be claimed if I leave my house to my children. That can only be claimed if my estate isn't £2 million or less. Once you get to £2 million, it is tapered away, and when you get to 2.35, it goes completely. So I can see that some people might say, well, good, I'll leave all my assets to my spouse and she can pass them on, or vice versa, and claim the inheritance tax reliefs. That's good. But if your estate, as a result, goes more than £2 million, the residential nil rent band can't be claimed. So in general, I think a lot of planning still needs to be made, and I'd recommend people to revise and look at their plans every sort of 2 or 3 years to make sure that it's still efficient from an OHT standpoint. VAT, the VAT rates remain the same, but there has been a movement that from April 26, if as a business we donate goods, we do not have to repay the VAT. So at the moment, if we buy some goods and then give them to a charity, apart from a few exceptions where, for example, the charity signs a document that say they're going to resell those goods, I would have to repay the VAT to HMRC. The reason being is I have not used those goods in my business. They've gone left. Now, subject to limits, which are not to be, which will be announced shortly, we're told. If I donate goods to a charity, then I can keep the VAT that I have reclaimed on those goods. I hope I've made that clear. And there's going to be a consultation on what to do about goods coming into the UK. At the moment, if the goods come into the UK and have a value of less than £135, no duties, no VAT is due. Now, there are companies, some large companies, begins with an A and ends with an N, that have been able to use this loophole to send goods into the UK and avoid paying VAT and import duties. And so there's going to be a consultation on how to reform the rules. There's basically what they are saying is they need to have a balance. You know, if somebody, you know, if somebody sends me a present from abroad and it's a proper present, then I don't want to have to be paying VAT and import duties. But if that loophole is going to be used by other people, then they need to look at it. There has been a change on private hire vehicles. Looking at the attendee list, there's nobody here that I know of who is involved in the taxi business. But just to highlight that if you're running a taxi firm and you are employing taxi drivers in your taxi firm, you just need to look at the VAT status, because HMRC are looking at this closely. They're closing one of the loopholes from the 2nd of January 26. I think primarily this loophole was used by Uber and by, I think it's Bolt. I think I saw, and I think there was one of the other ones, is the major players in the marketplace. But it was a way of them avoiding paying VAT on a lot of the money that they take. But it will affect, as I say, your regular taxi curb firm in Hadley, Ipswich, you know, wherever they are, because HMRC will be looking at those arrangements and saying, is the correct amount of VAT being paid? So there is a model where what you have is you have lots of taxi drivers and you have one person at the top taking the call. And what you say is that you only pay VAT on that margin, that profit that you make. The money you pay to the taxi driver, you're saying, well, that's his money, therefore no VAT is due on it. And HMRC is saying, no, you have to look at the arrangement very carefully, who arranges it, who takes the call, etc. So I just something to be aware of. And then finally, anti-avoidance. In every budget, the Chancellor always says, and we're going to be clamping down on anti-avoidance. And there's been another load of measures brought into being. So just to name sort of 5 that caught my eye. Personal tax, they're going to revise the offshore anti-avoidance legislation. I interpret that looking at papers that they know it doesn't work at the moment, so they're going to look at it again. They're going to be looking at promoters of marketed tax avoidance schemes. So these are firms that are out there that are selling and dreaming up schemes and ways to save tax, and they're saying that they're going to clamp down even further than they are already. I mean, there's already a lot of regulation. They have to report themselves to HMRC. They have to report the scheme to HMRC. If you use the scheme, you have to put the reference number on your tax return and so on. It's more aggressive tax planning that most people don't get involved in. But what they're saying is we're going to really clamp down on these people. They're launching the strengthened reward scheme. Basically, this is a reward scheme where if I am aware of somebody who is involved in tax avoidance, I can report them to HMRC, and if HMRC go after them and gets money back, then I get a percentage of the money that HMRC gets. It's based upon the American model. Well, as I say, they're ramping up the use of that, and they're making it slightly more beneficial for people to report tax avoidance. They're looking at donations to charities. There is a boost. I'm involved in a number of charities, and I'm aware of a number of schemes about where charities are abusing gift aid. So where, for example, a charity might say, well, you give me some money, and by the way, I'm going to give you something in return. It's this sort of thing that these anti-avoidance rules will be looked at. If it's your very simple low-level stuff where you go to your museum and they say, do you want to gift aid that entry fee? That's still going to be fine. That's still within the rules, but it's more the major stuff. Yeah, and then finally, for us as a firm, all tax advisors will have to be registered with HMRC as well as their governing body if they're regulated. This is coming in from May. This is in response to some accountancy firms that have been doing more dubious things. There's one locally in Stowmarket, which if you don't know about, you can Google and probably find out the details about. And so what they're saying is from May, agents will have to be registered. So as a firm, we will be registered with HMRC as well as our governing body. But what it gives the HMRC the ability to do is to, in a way, police that relationship. Because underneath these regulations, if the accountancy firm is found to be failing, they will have the right to cancel the registration, which will then put the accountancy firm out of business because they won't be able to deal with HMRC. So it is going after more unscrupulous practices. The tax profession itself have issues with the whole thing, which I won't bore you with now, but just to highlight it, that they are going to be clamping down on it. And it also means that if you have people who are doing tax work on the side, they won't be able to deal with it unless they register with HMRC and comply with all the money laundering stuff. So it's a way of cleaning up the sector. So thank you very much for sticking with me this morning. We will be sending out a copy of the slides and the video, probably that will be tomorrow, so you can look through them in more things. If you have any questions, by all means, email me. My email address is mark@walterwright.co.uk. And as I say, I'll be more than happy to deal with them, or you could talk to the person that you normally deal with in the firm. So thank you very much for joining us. I hope you found something there useful. There will also be a feedback form, so you can give your feedback for where we plan the next one. So thank you very, very much for joining us, and I hope you have a good rest of the day. Thank you very much.